here's what we have. Okay. We have the money supply saying we have a recession baked in the cake,
Yeah.
or we have the yield curve inverted saying recession is lying ahead. We look at the traditional measures for the leading indicators by the conference board, for example, and those have been negative for 22 straight months, and they indicate, as the conference board now says, a big slowdown is coming.
In this episode, Steve Hanke, professor of applied economics at Johns Hopkins University, joins us. He'll be discussing with us monetary policy, the future of the economy, the latest economic data, and something that's very interesting, a perpetual calendar. What is it? Can it be implemented? What would happen if it is? Stay tuned. This is a very interesting discussion. First, a word from our sponsor, Moomoo. Charlie Munger once said, "Those who keep learning will keep rising in life." In the world of investments, this wisdom holds more truth than ever. Moomoo believes that the cornerstone of successful investing is continuous learning. That's why it crafted an innovative brokerage platform that's not just about trading, but also about empowering investors with knowledge. The app provides comprehensive educational content, whether it's stocks, ETFs, options, funds, macroeconomic data, technical analysis, and much more. You can find corresponding courses for all of these topics. Now, I understand that many of you watching right now are quite busy and don't have dedicated time for learning. That's where Moomoo shines. Each lesson in Moomoo's Learning Center is designed to be brief and interactive. With just 1 to 2 minutes per session and small quizzes, you can conveniently enhance your investment knowledge and your spare time. It's about making incremental progress that adds up significantly over time. For instance, if you're interested in learning about options trading, simply open the Moomoo app, click on Options, and there you'll find the relevant courses. Moomoo provides a whole series of study plans. It's a step-by-step, simple, and user-friendly process. But what's knowledge without practice? Well, with Moomoo, you can get to put your learning into action. Their free paper trading feature allows you to trade options, stocks, and futures in a risk-free environment. Experience real market scenarios, develop your strategies, and build confidence without risking a dime. It's more than just a simulation. With Moomoo's paper trading, you get real feelings of trading and investing before you risk any of your own real money. Join the community of smart investors who choose Moomoo. Learn, practice, and grow with an app that's just as invested in your financial journey as you are. Moomoo is giving its cash sweep program an exciting upgrade now, offering 5.1% APY plus an extra 3% APY on uninvested cash. Limited time offer only from January 15th to February 29th. New users can also receive up to 15 free stocks with a $1,000 deposit and an extra free Amazon stock if you deposit $6,888. Thank you very much for joining the show again, Professor.
Great to be with you, David.
I want to start by talking about or addressing a question that came in from a viewer. I'll put the viewer's Twitter bio handle on the screen here. I got a message, Professor, through my Twitter inbox. By the way, if you're watching this right now, feel free to submit questions to either myself or Professor Hanke. I'll put his email in the description down below. Professor Hanke is going to return to the show every 2 weeks. So for the next time, if you have questions for him, email him or myself. So anyway, this question's a two-part question. Professor Hanke says a recession is baked in the cake for late 2024. If he had to put a percentage odds on this happening, what odds would he assign? Does he think this will be a mild or harsh recession?
Okay, let's just use it. It is baked in the cake, but let's just use the 80-20 rule. But let's say 80% or greater.
Okay.
Now note that the leading indicators have come out recently. They've been negative actually for the last 22 months. The last time they were negative for so long was when Lehman crashed, and we had the great recessions, great financial crisis beginning in 2008. But at any rate, the leading indicators now are indicating not a recession, but a significant slowdown. John Greenwood and I are calling a recession, but let's just put the number at around 80% or above. And the reason for that, by the way, is that the fuel for the economy is the money supply. And the money supply in the United States since March of 2022 has been shrinking. It's shrunk by about 4.5%. It hasn't done that since 1929, 1933 period. And there have been, in addition to that episode, 3 other episodes. All 4 of those episodes of contraction in the money supply have resulted in recessions, which is what you'd expect. I mean, if the money supply is shrinking, you expect that nominal GDP, that is inflation plus real GDP, that's a nominal, that would definitely go down, and probably the real component would head into negative territory. And that's what's happened in the past. So that's why I'm putting that percentage on there. Whether it's going to be mild, the second part of that question, whether it's going to be severe or mild, I don't know. And I don't know exactly when it's going to occur. And the reason for that is that there are long and variable lags between changes in the money supply and changes in the economy and economic activity.
Would you not say could the magnitude of the growth of the money supply, or contraction in this case, indicate the severity of a recession? Suppose the money supply were to just contract marginally, or not even contract, but just grow at a very small rate or low rate. Wouldn't that indicate a mild recession versus a huge contraction, which is what we had?
Well, yeah,
which would be a
that's
severe
true.
yeah.
Yeah, that's true. If you look at 2933, I don't have the numbers right in front of me, but they're much, much greater, the contraction in the money supply, than the 4.5% we've realized since March of 2022. So, yes, I mean, that wasn't a recession, it was a Great Depression.
Mm-hmm.
And the reason for that is that there was a very significant decline in the money supply, contraction. I mean, it was into the double digits. It wasn't 4.5%.
But by the way, just off topic, we'll get back to this. But since you brought up the depression and the money supply contraction at the time, some economists argue the implementation of the Smoot-Hawley tariff was the cause of the depression. Do you share that view?
Well, yeah, I do. That was part of it. There was kind of a cascade of bad policies, kind of a deadly cocktail was mixed once it got going. But the real thing, the key thing, was in fact the money supply contraction. It was
Okay.
the Federal Reserve. It was they were doing, instead of counter cyclical policies, they were doing pro cyclical policies. They were doing policies that in fact were driving us deeper and deeper into a slowdown and eventually a Great Depression.
Understand. All right. The second question this particular viewer has, what does Professor Hanke think about this chart floating around Twitter? I'll put the chart on the screen for the viewers. Basically, can the Fed shrink M2 and then later get us back to the golden growth rate of 6% in the long-term trend line as shown by the black line? If you recall this chart, Professor, it's
Yeah, well,
M2,
they can. I mean, they've gone up and they've gone down. My point is, what's Hanke's golden growth rate for the money supply measured by M2 in the U.S. economy? That is a rate consistent, the Hanke's golden growth rate, a rate consistent with hitting the inflation target of 2% that the Fed is. It's about 6%. And what did we have? We had, first, the money supply zoomed up. By February of 2021, it was actually growing at about 27% year over year, and now it's actually contracted and is growing year over year at negative 3.1%. So we've gone a roller coaster ride, zooming up to unprecedented heights and almost collapsing to near unprecedented levels now. So up and down, up and down. And what you want to do, a sound monetary policy would be to be focusing on the money supply and trying to keep it around growing at about 6% per year. And if you did that, the inflation rate would be about 2% per year in the United States.
Okay.
So they can goose the thing again and get it back up to the 6% level. That's fine. But remember, there's a big lag between that getting back up to the trend and having things, shall we say, stabilize, normalize.
What does last question from this viewer? What does Professor Hanke think about the yield curve inversion? Does he pay attention to the 10-year minus 3-month curve or the 10-year minus 2-year or something else? How does he think the yield curve will uninvert when the recession is closer? In other words, will the short end fall because the Fed is cutting? Will the long end rise because the bond market, because of the bond market, or both? Something else?
Well, first of all, yes, I do pay attention to the yield curve because the shape of the yield curve does throw off, can throw off, and has thrown off strong signals about the course of the economy. The money supply is the key thing, but the yield curve kind of complements that, and the yield curve is negative now. The short rates are higher than the long rates, and that's been with us for quite some time, as is the contraction in the money supply, and that inverted yield curve usually almost always signals that we're going to have a recession.
Yeah.
So it's essentially saying the same. Here's what we have. We have the money supply saying we have a recession baked in the cake, or we have the yield curve inverted saying recession is lying ahead. We look at the traditional measures for the leading indicators by the conference board, for example, and those have been negative for 22 straight months, and they indicate, as the conference board now says, a big slowdown is coming. They were calling for a recession, the leading indicators. Now they've dialed that back to just say a significant slowdown. So everything is pointing in that direction. Things are going to slow down.
All right. Well, speaking of slowing down, well, thank you once again to the viewer for submitting those questions. Let's move on to talk about inflation, whether or not the rate of inflation has been slowing down. It actually hasn't been by much. 3.1% was the latest headline inflation numbers. You and I haven't talked about the latest reading that came out, I think, a week and a half ago. The stock markets came down significantly on the day of the release because the expectation was, I think, 0.1% higher than it actually was. So it took people by surprise, even though the surprise wasn't even that significant. Anyway, how are you reading the progression of inflation, should we say?
Well, it's with the money supply going down and contracting, we know that inflation will follow that and go down, and it is going down. I mean, the reading, by the way, in December was 3.4%. The new reading is 3.1%. It's going down. So, and if you look at the producer price index, it's only growing at 0.9% per year, and the personal consumption expenditures, that's growing at 2.6% per year. So, and inflation is the trend is going down, and as I indicated, I think the last time we were on, John Greenwood, and I think by the end of the year, the headline consumer price index will probably be down at 2%, or maybe even less than 2%. So none of this surprises me, and it doesn't, because it is baked in the cake. Whatever happened to the money supply a year and a half or 2 years ago determines what's going to happen with inflation now.
Yeah.
So there's just a huge lag between changes in the money supply, changes in the fuel, if you will, in the economy, and changes in economic activity and inflation. They just don't happen automatically. Of course, that's the trick. Everyone reading the newspaper, what do they look at? They look at the current data. But the current data are just symptoms of what was causing those data to change around. And that causality occurred, maybe a year and a half, 2 years ago, a long time ago. People can't, number one, people can't even remember, hardly their name for that long in advance, let alone the money supply. And of course, typically no one looks at the money supply anymore anyway. They're not looking at the right thing. They're looking at the data that are coming out today, and they think that's telling them what is going to happen with the economy going forward. No, you have to look at what's happened to the money supply a long time ago, and read those tea leaves, and you get a pretty good picture of what's going to happen down the road.
I'm curious as to what you think about the labor market once AI becomes more, I guess, ingrained in our lives. Just sidestepping from the Fed for a minute. Do you think that unemployment will significantly increase, as some may fear?
Well, not necessarily. I mean, there'll be a lot of structural change. I think jobs that will be taken over by AI and robots, shall we say. In Japan, they everybody says, oh, Japan has a big demographic problem. People are getting old and the population isn't growing and so forth. So what do? In the context of AI, they have retail stores now in Tokyo that are actually run by robots. If you walk into the store to buy a suit or whatever they happen to be selling, the robot gives you the thing and takes your money and gives you whatever you bought. So this is, there'll be a substitution of robotic types of things going on, and much more efficiently things going on. For example, just to give you one example, valuing a company. Well, to value a company, at a minimum, you've got to figure out what the free cash flow is, do some kind of, have a discounted free cash flow model. And how do you do that now? Well, now you manually put everything on a spreadsheet, all the inputs and the cost of the inputs, and then the revenue stream coming in, the top line thing. You put all that on a spreadsheet and manipulate it and discount it to get a discounted cash flow and a valuation of whatever the company happens to be.
Yeah.
With AI, now we are able to do that. One of my former postdoctoral students, who's a Silicon Valley guy, has just started a company in which the AI will be able to automatically put all this data in the spreadsheet. So instead of taking 3 days to do it, it'll take 3 hours.
Mm.
And in addition to that, there won't be any mistakes. Now, if you and I are putting those numbers in a spreadsheet, and we've got a big matrix of things that we're looking at, David, there's a chance we'll make a mistake. And what happens if you make a mistake in a spreadsheet? It's almost impossible to find the damn thing, and you really are better off just starting the whole thing over again.
A lot of junior investment, yeah. A lot of junior investment banking analysts are about to lose their jobs, it seems like.
Absolutely, you'll need very few of the young associates at these investment banks doing spreadsheets, because AI will take the thing over. Now, your question is, in the broader labor market, what will happen? Oh, that'll be a wonderful thing, because they'll be freed up and they can take other jobs. There'll be other things to do.
Yes. All right. We'll follow up on that as there's more.
So the
progress.
idea, yes. This goes back to many things that have been discussed over and over again. But one, when we first started seeing robots, because by the way, the robots are used very heavily in like making automobiles and things like that. In manufacturing, robots are used a lot. And a lot of people, especially labor union people, what do they get worked up, and they try to get a narrative spun that robots are taking over the labor market, and there'll be no jobs and everybody will be unemployed. That's the narrative they want. No, the reality is that the robots will just take over some of the jobs on the automotive assembly lines, and those people will do what? Well, they'll find other things to do. Maybe they'll be, of course, maybe it won't be that great for them, because they're getting high wages now on the assembly line. Maybe they'll be in McDonald's flipping hamburgers or something.
It occurs to me. So people were making parallels. We'll get back to the markets just a bit. Well, people were making parallels to the Industrial Revolution. They were saying, well, back then the farmers were put out of work and they all moved into cities and whatnot. So it was fine. People just shifted labor. Yes. But when you think about it, they went from manual labor to manual labor, right? Here we're talking about the destruction of low skill labor by robots. So you have to, there's a structural change that needs to happen in education and upgrading people's skill sets before they're able to find work. It's not like, well, I was on a farm, now I can just move to a factory. No, the factory work is going to be done by robots as well.
Yeah, right. You're going to have to be more flexible and be more willing to get yourself trained.
Yeah. Okay. Let's talk about this article that came out a while ago on sanctions. You were quoted talking to Mike Pompeo about sanctions. I'll read a quote here for the viewers. Now the paragraph says, in 2020, U.S. Secretary of State Mike Pompeo called Hanke to discuss the imposing sanctions on Hong Kong as his autonomy was being undermined by China. Pompeo told him that a final decision would be made by President Donald Trump the following day, and that Hanke's opinion had been requested. Pompeo had argued for sanctions while Hanke was adamantly against them. You had opposed the use of such tools, says the article, on grounds of both principle and practice. In an interview, he said that he was a strong supporter of free markets and free trade, and that he opposes all forms of protectionism, whether they be tariffs, quotas, non-tariff barriers, or sanctions. I guess this conversation is going to become more relevant as the presidential election draws near, Professor. Certainly this argument is going to come back. Okay, so why not sanctions? It seems that protecting domestic industries resonates with a lot of people. Not a good idea?
It's basically a stupid idea in the sense that, as you just articulated, I'm against them in principle because they are a form of protectionism, and I'm against protectionism. I'm a free trader, but as a practical matter, it's just an empirical practical matter. If you look at the scholarly literature that's out there, sanctions are not they're not an alternative for war, but they're a cause of war. So they cause a lot of problems in practice, and they rarely accomplish their objectives. So that if they don't work. There are a million workarounds. There are ways to get around them, because if you put sanctions on somebody, a black market and illegal activity pop up all of a sudden, and they figure out a way to get around them. They also create what's called a rally around the flag effect, and that is, in any country or any leader that you put sanctions on, they tend to stay in the saddle because the population rallies around the flag. The population in Russia makes Putin more popular because they say the West is attacking Russia. Venezuela, we've had Maduro in power for 10 years in Venezuela. He's not going anyplace. Cuba, Castro, he never went anyplace because we had all these sanctions. The mullahs in Iran, they're not going anyplace. We got all these sanctions. North Korea, same thing. It's all rally around the flag. and you end up with a massive amount of unintended, very costly things that occur. They backfire, the sanctions. Just look at Russia and Europe. Russia's growing pretty strongly now, and Germany is decimated. It's not growing at all. Europe's going down the tubes. Europe imposed the sanctions on Russia. Russia is going to be growing, most estimates, between about 2.5% and 3% next year. Europe is flat on its back because of the sanctions blowback, the backfire.
Okay.
Germany's not getting cheap oil from Russia. Russia's sending its cheap oil to China and India now, and as a result, the industrial base in Germany's been completely hollowed out.
What is the argument for tariffs? So you've made the argument against sanctions.
There are no there. The argument boils down to this again. The scholarly literature shows that sanctions, the history of sanctions, is a history of failure. They never work as intended. You have all kinds of collateral damage, unintended consequences, and they never work as planned. Now, why do they do them? Well, politically, it's fairly easy to do. You don't go to war and send a battleship over and start shooting at somebody.
Right.
You sanction them. You say, oh, they're bad guys, and we as politicians, we are doing something against the bad guys. We're the good guys. We're the guys with a white hat. So it's a symbolic thing more than anything else. But you have to remember, how do you define insanity? Insanity is doing the same thing over and over and expecting different results. So it's insane.
Well, maybe Russia wasn't the best example, but certainly sanctions have done their deal on Iran or North Korea or any rogue nation.
You must be kidding. This is totally false.
Okay.
You've been brainwashed like everybody else in the press.
All right.
This is Vali Nassar, one of my colleagues at Johns Hopkins, a former heavyweight diplomat, has just produced this book. You see this? How sanctions work. It just came out. Stanford University Press, one of the high quality academic presses. What does this book tell you? It tells you a whole book of why sanctions have failed in Iran.
Okay.
And Valley, by the way, knows what he's talking about because he is Iranian by origin, shall we say? And so were his colleagues that he wrote. There are 3 other authors on that book. He didn't author it alone, but at any rate, this is why they do sanctions, because they have people like you broadcasting that they've worked. No, the evidence is, if you dig into the scholarly literature, no, they do not work. They almost never work.
Okay. You know what? Since we're talking about this, let's address some misconceptions. I'm reading this article from CNBC dated a few years ago, 2021. I'm just going to quote it. I'm not going to give my own opinion. These 6 charts show how sanctions are crushing Iran's economy. So we don't have to go through the entire thing, but Iran's economy shrinks. So Iran's economy's last reported growth in 2017. Obama tightened sanctions around 2012 to 2015, and the economy has been shrinking ever since then. That's one. Oil production and exports have been hurting. That's another. World trade with Iran falls. So I think I think you get the point. They're quoting certain economic stats.
Here's the point. Here's the point. Whoever's putting that, it's probably some neoconservative putting this propaganda out. This is a grand Wurlitzer. Comes right from the CIA. The CIA says we're successful. We put sanctions on. We're successful. Has the Iranian behavior changed at all because of sanctions? Has the regime changed? Has anything changed? No. Nothing has changed, except, of course, the Iranians are hurt. The population is hurt. There's no question about that. It isn't that they have no effect. They don't
Right.
have any desired effect. That's the point.
I see.
And they are not an easy way to avoid a war. They are a way to start a war. What do you think's going on in the Middle East? Have you paid attention to what's happening in the Middle East right now?
Yeah, I see what you mean. So
Who's stirring the pot with these drones and so forth? You've got these Houthis over there. They don't even wear shoes. They're wearing sandals, and they're knocking the hell out of the West. That we've got B-52s and everything else flying over there, dropping bombs on empty warehouses and so on, and nothing is happening.
okay, what should be the appropriate policy response to a rogue nation acting out against another foreign state?
Let's take one step at a time.
Yeah.
We got to view this thing like a bushel full of apples, and we have that's all the nations in the world. We've got a basket of apples, and we've got a rogue in there. We got a rotten apple.
Okay.
So the question is, well, you're saying, well, what do you do? And I'm saying,
Well,
we know that sanctions are in fact a rotten apple. So what do you do with rotten apples? You try to get them out of the basket, and with sanctions, we know they don't work. So why would I advise the use of some mechanism that didn't work?
what was the conversation
Again,
you had with Pompeo?
I don't have any suggestion except to use diplomacy. You have to talk to the other side.
Right.
How do you come to peace agreements? You do it diplomatically. One side talks to another, and they finally narrow down their differences and come to some agreement. So you use diplomatic solutions. And of course, the worst of all possible things is to actually go to a shooting war. The next worst thing is to go to a sanction kind of war that doesn't work. So the option is diplomacy. Now, the details of that, how you would do it, I don't know. It depends on each country and each situation. But we would have been a lot better off with Cuba, for example, if we had not done sanctions and we did some kind of diplomacy.
Okay, well, let's just take Russia, for example. You argue that sanctions have not been effective against Russia. Well, what could the West have done, short of putting the military on the ground?
They should start talking to Putin. Putin did an interview with Tucker Carlson not too long ago, and the interview, there was one thing that was made clear. Listening to Putin, I listened to it very carefully. He said he was willing to talk to the other side to come to some kind of resolution and stop the war. And of course, war is the enemy. You want to stop a war. But his problem is no one on the other side wants to talk to him.
Okay. What was the conversation you had with then Secretary Mike Pompeo in 2020? He wanted sanctions on China, right?
No. It was on Hong Kong. This was
Hong Kong. Yeah. Okay.
This was the democracy protest. The protest against mainland China supposedly interfering with democracy in Hong Kong. And as a result of those protests and the alleged intervention, the U.S. was considering putting sanctions on Hong Kong, financial sanctions, and those financial sanctions were something that obviously I was opposed to for the reasons that I've just given you, as a matter of principle and practice. And Pompeo was on the other side. So we had a 35-minute conversation, and at the end of the day, it was one in which we ended a bit, basically where it was a very friendly conversation, but and ended with him retaining his position and me retaining my position. And the next day, the only thing I know, I got a message from the White House saying, Hanke, you won. We're not putting sanctions on Hong Kong.
Okay.
Which would have been a complete disaster. There would have been a lot of blowback from that because, for one thing, Hong Kong has a currency board. The Hong Kong dollar is issued. It trades at 7.8 Hong Kong for $1, and it's backed 100% with US dollar reserves. Now, the Hong Kong dollar, therefore, is a clone of the US dollar. It's the same thing as the US dollar because you can freely exchange 7.8 Hong Kong for $1. And you know you'll get the US in that exchange because they have 100% reserves. Now, if the sanctions would have been put on, those reserves would have probably ended up being frozen. It would have been like the US confiscating US dollar reserves, confiscating US dollars that were being held in reserve by the Hong Kong Monetary Authority. It would have been like theft.
Yeah.
So not only it was a form of protectionism, which I'm a free trader, so I'm against that, but it would have in fact amounted to weaponizing the US dollar and confiscating it, freezing it.
Okay. One last argument.
Now you're not for
sorry.
theft, are you, David?
Now I see that's a complicated question. So if I have to steal to feed my starving family, am I morally wrong or right there? That's
Well, as far as I know, the United States isn't starving and they don't have to go to Hong Kong to steal dollars to. So
fair enough. President Trump, during his term in the White House, has argued repeatedly that to protect domestic industries against rivals like China, we have to implement protectionist measures, including the use of not sanctions on China, but tariffs, right? Implementing tariffs, taxes on trade, providing incentives for people to trade domestically and not with the Chinese counterparts. I mean, a lot of workers supported this policy.
Yeah, well, you said Trump. Well, Biden is the current president. Biden doubled down on all these protectionist things,
Right.
and subsidies and industrial policy that Trump had. So actually, in reality, Biden on this count is even worse than Trump. And now Trump is campaigning. He wants to double down on Biden and be even worse than Biden is. So you've had this thing ratcheting up. Trump on trade was a disaster. Biden on trade is even a bigger disaster. Now Trump is campaigning saying, I'm even going to be a bigger disaster than Biden. So this thing is off the rails. It's going in the wrong direction.
It doesn't help. It doesn't help workers in the U.S. though.
No,
keep their jobs.
No, it's a complete disaster. It doesn't. And by the way, to the extent that it saves any jobs, if you actually look at any studies that have been done, to save a job, and again, this is just roughly, to save some of these jobs, the cost to the U.S. taxpayer is in the neighborhood of $500,000 or $600,000 per job per year. It's not a very good deal. In short, if you save a job, it's going to cost the taxpayer way more than the value of whatever that job saved is being produced.
Okay.
So it's just utter nonsense.
We're running out of time. We don't have time to cover the latest updates on Argentina. We'll do that next time, Professor, when you're back in 2 weeks, along with some other topics and questions that I'm sure we'll be getting from the viewers. But I do want to talk about your calendar. This is, we'll finish off here. I've never seen this before. This is what's called a Hanke-Henry permanent calendar. I'll put an image on the screen for the viewers here. And you've basically here proposed that we restructure the calendar. Uh, and you have basically, how does this work? So every single day of the
Okay,
year
okay,
will be it'll just be the
okay.
same. Yeah.
Here's it's Hanke-Henry because Dick Henry, a professor of astrophysics at Johns Hopkins, and I developed this thing.
Yeah.
It's not the only permanent calendar that exists, but it's now the best one. So, what is a permanent calendar? First, a permanent calendar is one that never changes. In other words, 2024 calendar will be exactly the same when 2025 and 26 roll around. That means the same day will turn up on the same date every year forever. So, for example, what's your birthday, David?
June 30th.
Okay, June 30th on the Hanke-Henry permanent calendar. We are at a
Saturday.
Saturday. Your birthday will be on Saturday for as long as you live. Never change. January 1st is always on a Monday. July 4th in the United States, of course, that's a holiday, Independence Day. That's always on a Thursday.
Right.
Memorial Day in the United States is the 27th of May. That's always on a Monday. Labor Day is on the 4th of September. That's always on a Monday. Christmas for everybody, December 25th. That's always on a Monday. Now, the calendar is structured in this way. It has 4 quarters. The first 2 months of each quarter have 30 days, and the last month has 31 for each quarter. And it has a total of 364 days. And now we're getting to the point of why are we talking about this? We're talking about this because this is leap year. The end of this month won't end on February 28th as it normally does. This year is leap year. We're going to have February 29 if you look at your calendar. We'll have an extra day in the Gregorian calendar. Now, why is the extra day in there? The extra day is in there because 365 days in the Gregorian is less than 365 and a quarter days, which is the time it takes the Earth to rotate around the sun.
Right.
So we lose about 6 hours every year with a Gregorian calendar because of this 365 being less than 365 and a quarter. And as a result of that, every 4 years we add an extra day to make it up. And that allows the calendar to avoid calendrical drift, the drifting the month into a different season. For example, in 100 years on a Gregorian calendar, if you didn't have leap year, you'd lose about 24 days, almost a month. So January in 100 years, if you didn't have leap year, it would be sliding into from a lunar point of view, what we normally see for light and everything in February and so forth. So now we get to the permanent calendar, Hanke-Henry permanent calendar that never changes. How do we deal with the drift? You wouldn't have leap day every 4 years, adding February 29th. You'd add an extra week at the end of December every 6 years. And that would stop the drift. That would mitigate the drift problem. Now, why do you want a permanent calendar? Why do you want to get rid of the Gregorian? For logistical purposes, for scheduling purposes. Every year, every organization has to redo their calendar. Schools have to have a new schedule, a new schedule. Sporting events, sporting leagues. With a Hanke-Henry permanent calendar, you could schedule all the baseball games. You'd know what day they were occurring every day forever. You also could schedule all federal holidays and national holidays around long weekends. So they either you would add the holiday on a Monday. Notice Christmas on the Hanke-Henry is on a Monday. Labor Day and Memorial Days are Monday. That saves a lot of time because you don't interrupt the week with a holiday.
Yeah.
So and they've done studies about this in the United Kingdom. It would save about 1% of GDP, which
Really?
racks up. It's a lot of money, actually.
Wow.
So the calendar, a permanent calendar is very efficient. There was a world calendar that was George Kodak, the founder of the Kodak company in the United States, was a big advocate of the world calendar. So was a famous economist, Irving Fisher. They wanted a world calendar. It was before the League of Nations. It was almost passed in 1939. It didn't pass because the U.S. nixed it. Now, why did the U.S. nix it? They put the nix on because they wanted to add a day on the 29th of June, and that would have made the last week in June an 8-day week. It would have screwed up the 7-day week. It would have screwed up the Sabbath. And all the religious people in the United States were against that. So the United States caved into those lobbies and they nixed the world calendar. Notice that with the Hanke-Henry permanent calendar, we're adding 7 days at the end of December every 6 years. We preserve the 7-day week. We don't mess with the 7-day week. So that's why I think ours, if somebody like Elon Musk would get behind it, I think the thing would pass. And the president of the United States, with an executive order, could easily introduce the Hanke-Henry permanent calendar in the United States.
Yeah.
With a stroke of a pen. If the federal government went on it, the state governments would. Pretty soon, most businesses would.
I'm pretty sure switching to metric would also improve GDP, but it hasn't been done.
It would. Well, you did that up there in Canada a few years back. Maybe you weren't born then, David.
No.
You're young, but that switch, by the way, when Canada went metric, it went very smoothly.
Yeah.
Everybody says, "Oh, this is going to be a big pain in the neck. It's going to take forever to do it." No, it didn't.
Yeah, well, Canada is a smaller country, but yeah, I mean, this sounds like a good idea. Well, let's follow up on that. Hopefully, this gets the word out.
Put that on your screen so that everybody can see.
For sure,
they can see where their birthday would be on the Hanke-Henry permanent calendar, and they know the day of their birthday would always be the same. Yours is always on a Thursday.
But variety is the spice of life, Professor. Somebody might argue. I want my birthday to be a different day.
Variety is the spice of confusion and inefficiency. you want, for certain things, you want to routinely do them. Would you want to get up every morning and be facing a completely different kind of breakfast and you not even know what you're going to have?
That sounds like my mornings every day. Spoken like a true economist, Professor. All right, thank you. We'll see you in 2 weeks. And don't forget to email Professor Hanke in the email link down below, and follow him on Twitter at Steve Hanke. We'll put the Twitter handle as well on the screen. Thank you very much. We'll see you next time.
Okay, good, David. Have a good week.
Thank you. You too.